All right, Cleveland Cash Flows, direct method, and Brody barking because he wants to go outside. So we'll see how long that lasts. This is the balance sheet worksheet for the direct method. You have a file that has this in it, and you see the top section is the balance sheet, and it's followed by an income statement, and that's Brody singing, an income statement, and then there's a section down at the bottom for the statement of cash flows. All right. So the way that we are going to start in the direct method is we're going to start by just going through this income statement and looking at the operating activity section. Line by line, we're going to turn the lines on the income statement into statement of cash flow lines in the operating section. So our starting point is going to be right here on sales revenue. And what I'm going to do is I'm going to find the balance sheet account where the other side of all of my sales that were recorded, where was the other side recorded? And that's basically how we're going to get to where we need to be. So if you were to think about it for a second, you would say, oh yeah, the other side of sales is accounts receivable, right? So I know that accounts receivable gets bigger with sales. We're looking for the cash paid for, or cash received from customers, and that's going to be the amount that was received in that accounts receivable account, which is what makes it smaller. Okay, so we might think, oh, okay, we can just stick the whole difference in here and call that cash received from customers. We could do that, except for the fact that there could have been some write-offs, and write-offs also make accounts receivable smaller. So we need to actually take care of the allowance account to verify whether or not we had any write-offs that would have impacted our accounts receivable. So jumping down to my income statement again for a second, I'm looking for bad debt expense. And I am going to put a little A1 by my bad debt expense. You know, it's related to accounts receivable. It's not exactly the same account. So we know that when bad debt expense is recorded as a debit, the credit goes to the allowance for bad debt. So that's why I've got that right there. All right, so now if that was all that happened in my allowance account, it would have zeroed out, but it didn't. So that tells me that there must have been a write-off, because that's the only thing that happens in an allowance for bad debt accounts is, you know, how they are impacted by the write-offs. So I'm actually going to call this a little A star here. And I know that a write-off would have decreased the allowance for bad debts, and it would have decreased the accounts receivable. So once I do this, now I can see the actual cash received from customers. This is that remaining credit in the accounts receivable account. So this is the number that I'm going to put in my statement of cash flows. All right. Here's how I'm going to do that. Because I need to clean out this change, and my change, I want that to be zeroed out. So I'm going to, whoops, that is not what I wanted to do. I'm going to add those two numbers together and zero out the account. But I'm going to remember when I get down here to the statement of cash flows, this is my very first line on the statement of cash flows. This is my little A star, that I had 200 extra in there for the write-off that was not part of the cash received from customers. Okay, so that's the start. That's my starting point. All right, I'm just going to continue to work my way down the income statement. and going up and finding the balance sheet related accounts and looking for cash items for my operating activity. So cost of goods sold, if you think about it, you know that cost of goods sold is related to inventory. Every time cost of goods sold is debited, inventory is credited. So I'm just going to pick up the amount there from the income statement, that's $748. So that's what makes my that's what makes inventory smaller. What makes inventory bigger is purchases of inventory. Okay, so purchases of inventory would be the debit to inventory. The credit, now we're assuming when we're doing the statement of cash flow that we use all of these accrual accounts. Okay, so the other side of inventory is going to be accounts payable. Okay, so I debit purchases for $755. I would have credited accounts payable for $755. Remember, we're looking for cash paid to suppliers. Well, accounts payable is actually the account where that comes into play. So the accounts payable becomes smaller by the amount of cash we actually pay to our suppliers. And I can tell by my difference over here that I need $760 to make that zero out. So $760 is going to be my cash paid to suppliers down here in my statement of cash flows. Now I also will draw your attention to the fact, that there is another video that shows how to do this operating activities section just using T accounts, because some people find that easier than the spreadsheet. So I'm going to continue using the spreadsheet for a while. All right, so we have these selling expenses. This is my item C. If I look on my balance sheet for something that looks like it would be related to selling expenses, honestly, I'm not going to find anything. If there was a prepaid advertising or some kind of advertising accrual, that might be a case, but there's not. So I get to make a simple assumption that all of that advertising or selling expenses were paid in cash. So I'm just going to put in the number, and this is going to be cash paid for selling. And there's my dog, who's been quiet for a while, but not anymore. All right, the next item is rent expense. Rent expense is going to come up here, be related to rent payable. We know every time that rent expense is debited, prepaid rent, is going to be credited. So I'm just going to pick up that amount. I'm going to see if I can get that crazy dog to be quiet. All right. And then I need to come up with the cash paid for rent. All right, my cash paid for rent is what it takes to clean out that account. And so that looks like it's $15,000 based on what I see over here, my handy dandy summary. So this is going to be cash paid for rent of $15,000. You guys understand my formulas up here in the balance sheet. These are basically doing T account math for me. So when I plug in 3 of the pieces, it shows me what's left, so I can figure out what the piece that's remaining. All right, so item E is going to be dealing with the insurance expense. We want to change that into cash paid for insurance. So I'm going to have a prepaid insurance account. I know every time that insurance expense was debited, the credit was to prepaid insurance. So I can pick that number up. Prepaid insurance. Again, this is the little formula that's doing T account math for me. And right now it is solving and told me that I need a debit of $13,200 to make this all balance. Make it all go away. All right, so that's going to be my cash paid for insurance. That's what makes prepaid insurance bigger. That isn't something that should be mysterious to you. You should be able to think back from your accounting knowledge and say, oh yeah, a prepaid account, it's bigger when you actually pay out the cash associated with that asset that you are prepaying. Put my little stars here, so if you looked at it later, or I looked at it later, we would know. All right, so that was my 13.2. Okay, moving right along. The next item is going to be the supplies expense. I'm doing the same thing. I look up on my balance sheet, I see office supplies. The way the supplies expense works is every time that is debited, the credit is to the account called office supplies, so I can just pick that number up there. I know what makes office supplies bigger is when I actually purchase supplies. So I have my little T account math working for me over here, so I know that I need $20,250 to make that balance, right? So that's my beginning, plus there's my debit, minus my credit, equals my ending balance. So that will be cash paid for supplies, cash paid for office supplies. And that is, I just had the number, $22.50. All right, working my way down. Okay, I've got wage expense. Wage expense, looking at my balance sheet, the other side of that is going to be wages payable. So every time wages expense is debited, the credit is to wages payable. Those two go together. Okay, I've got a beginning balance with a credit. Here's more of a credit, an ending balance of a credit. This little T account math tells me I need $98,700 and a debit to make that all balance. This amount represents with a payable, that's the debit when you pay it out, right? So that's my cash paid for wages. Cash paid for wages. And that was $98,700. $98,700. Yes. All right, here we are continuing to work our way down the income statement. We are looking for operating activity items. So when I get to here, I know that doesn't really affect my operating activity changes, so I'm going to just skip that. I know my gains and losses on sale of investment and short-term investment and unrealized holding gains, those don't affect things. But dividend revenue actually does. We know that dividend revenue is dividends received actually as an operating activity. So let's look and see if we have anything like a dividends receivable account. We would need to do that, but we don't. So I can make a simple assumption here that all of those dividends received were in cash, okay? Or that dividend revenue, I'm sorry, has all been received as cash. So that's just going to make my cash bigger by 200. All right, now on my income statement, I'm almost to the bottom. I've got interest expense. Here I would look in my balance sheet for an interest payable account, which we do not have in the ClevelandCashFlows, so we don't need to worry about that. We can also then make a super easy assumption that all of that interest was paid, interest expense was paid as cash. Right, so that was $51,750, just coming from that line right there. That's where that matches. And then finally on my income statement, I have income tax expense. And so I'm going to use the taxes payable account. Every time income tax expense is debited, taxes payable gets credited. So I'm just going to pick that up off the income statement. And then I am going to do some quick T account math, and we will be done, and I can go let the dog back in. $38,400 is going to be my cash paid for taxes. And you remember the taxes and the interest you have to do for both direct and indirect method. For the indirect method, it's part of the disclosures that go on the statement. For the direct method, it obviously becomes part of your operating activities cash flow. So this would be it. Cash from operating activities. It's going to be right there. So I'm just going to sum that up. And see if we get the number that I am looking for. And then I'll let my dog in. Not to worry, he is perfectly fine. He's just very noisy. And he loves the snow. All right, so there's my cash from operating activities. I'm going to take a little bit of a pause, and then I'm going to come back and continue with this to get the investing activities and the financing activities done.